S&P 500 as we get ready to trade March week 3. So we're already at monthly OPEX. On Friday, the March S&P 500 options as well as the ES March contract options, for Friday expiration, expire in the morning on the open, along with the ES March contract itself. It also expires on the open. So keep that in mind if you're in those March options on either S&P or ES, and that also the ES March contract will be expiring as well. Okay, so here's our intraday chart. Here was Friday's action. Here was our initial balance period that I always mark off with this blue box. It took us almost the entire day to break out of our initial balance range around 2:40 in the afternoon. We got a little look above it, along with this weekly all-time closing high level at the time that was still with us from Friday, February 12th. We were looking for a breakout over that all day. We finally got it around 2:40, fell back in, and then got a second breakout around 3:15. And then we even got this little annoying little heartbreaker rollover into the close, only to be turned in the final 5 minutes with an over 3 billion market on close imbalance to the buy side on Friday that got us closing at a new weekly and daily all-time closing high. So we had an all-time closing high on Thursday to go with our new all-time high, and we got not a new all-time high, but a new all-time closing high on Friday, along with a new weekly all-time closing high. And you know how I feel about these. This almost surely tells us that we have another new high in store for us, possibly on Monday, but most assuredly by Tuesday. So usually within the next 2 sessions. And what would that new all-time high be? Well, at minimum, it's going to be an effort to resolve the ES all-time high. But now that we're looking at the June contract, that's going to push the S&P 500 much higher. Right now, this is a conservative estimate of the spread. At times, I saw the spread be over 10 points, close to 11 points at times on Friday between the S&P and the June ES contract. So this is a conservative estimate, but at least about 39.6875, maybe 69, maybe 70 will be required to meet that level, and we always overshoot it anyways. So you probably ought to expect that we'll take a run at 39.75. That's a pretty heavily populated option strike to begin with. And if we look above that, then we have our plus 6% mark on the year at 39.82. And at that point, then we're into the 80 handle rule. If we get through 39.80 to 85, we're most assuredly going to go on to 4,000 using our 80 handle rule. If we come into the day on Monday, and for some reason we see a little bit of a pullback, we see a very clear line in the sand that built up on Thursday and Friday at 39.15. That was our low of the day on that handle, both on Thursday and Friday, and it's marking a nice little line in the sand for us, much like 38.86 did back in February. If we come down and we can't even break below 39.15, we're not going to be selling off any further. We're going to reverse and go up and at minimum resolve this all-time high. If not, go on and take a shot at 39.80 and then 4,000. Also, what's going on underneath us right now is that we have this 10-day, 20-day simple moving average bullish cross in our wake. This will definitely cross up through here, I would say, on Monday's open. Maybe that 3 billion bullish imbalance to the buy side on Friday was in anticipation of this. What happened last time these two babies crossed each other? It was back here in February, in the beginning of March. March 1st and March 2nd, where they bear crossed, and look what happened. We had a big sell-off. So this is the opposite effect of that. This is what's coming, on the heels of a bull cross. We could have a 100-point rally for all we know. I'm not going to get that excited about it. Let's just get this ES level resolved and see if that's all the market wants and we end up getting smacked back down. But if we do make it through here, then just use your 80 handle rule and look for that 39.80 to 85 and then 4,000 level to print. If we break down below 39.15, if this is not a new line of support that we're seeing build up, here was our high on Wednesday, low on Thursday, low on Friday, then we fill this gap to Wednesday's close, and then the 10 and that 20-day simple moving average are right below there. Also right around here, just below this gap and into Wednesday's range, is the top of our bear fork. It was on Wednesday that we broke out of it. It was all the way up at 38.98 on Wednesday. It's a falling line, and now it falls all the way to 38.91 on Monday. So if we do fill this gap and look down here, maybe all we're going to do is back test the top of that fork and reverse on top of the 10 and the 20-day simple moving average that will be in a bull cross. If I'm wrong about this, if there is an effort, in fact, to fend off this bull cross, much the way we often see a rally to try and fend off a bear cross, then we will indeed break that pair of SMAs, fill this second gap, and work our way all the way down here to the third gap that's down below us. We left 3 gaps in our wake last week. That would get us back to the 50-day simple moving average, and back to back to here where we actually opened, or actually, wait, 1, 2, 3, 4, 5. Yeah, this is actually where we opened last week up at 38.21. So that would be a more than 100-point sell-off from where we closed on Friday if that took place over the course of a couple of days this week. I happen to think that we're going to, at minimum, stay in our range and then maybe break out on Tuesday, or just go ahead and break out on Monday and then kind of like sit and simmer down for a while on Tuesday, because on Wednesday we have the Fed. So people are going to be positioning ahead of that and then waiting it out to see what the Fed says. And if the Fed spooks the market, then we sell off. Okay? Let's take a look at this chart. This is our simple daily chart with the fork on it that I was just talking about. So here you can see that move, that if we were to sort of fizzle out and come back down to test the 10 and the 20-day and fill a couple of gaps, or at least one of those gaps in, that gap back to Wednesday where we broke out of this, we would also be back testing this fork. I think this would be an incredible bullish move here to see this test and hold. And from here, you could get into some really juicy calls for a nice upside move. But of course, if this breaks and we get back into this bear fork again, break down through all of this stuff, maybe we would have that third and final test of the bull fork that we are in, where our low for March and then the following session where they both held the bottom of this bull fork, this comes in at 37.62 and rising as we go through the week next week. If this move were to happen, I'd be surprised to see this happen on Monday in the face of this stuff, but I suppose I could see a failed breakout that comes all the way back down here, maybe later in the week as we go into monthly OPEX, maybe on something the Fed says, and then this is a rising line. It will be much higher as the week goes on. So keep that in mind as food for thought. Finally, let's take a look at the options and how they shook out this week. This is where the March options left off on Friday as of the close, actually as of 4:15. So the volume leader on the put side were these 3900s. Well, with a falling VIX, this is a classic sign of people just rushing in and buying protection. You can get a 3900 put, with plenty of time on it, with the Fed ahead of us for only 16 bucks. Think of that as a double of the $8 window. So if you usually buy 2, you would just buy 1. And you would have all that protection if we were to break down below 3,900 again. 18,000 of those moved. That could just be what it was just people buying cheap protection instead of selling their stocks into this rally. It can also be a factor of people that had spent a lot of money on puts below here back when we were trading down here at the March lows, and they're just shorting this strike in order to get paid a credit and pay them back for all the money that they spent on these long options below here. Over on the call side, the volume leader is the 3900s, but obviously we blew past that. The next volume leader comes in here at the 3950s. Maybe that's why we were seeing so much, this breakout that took us all day and still couldn't get over 3950 even on Friday. Maybe it's short sellers of these 3950 calls. But other than that, you come up here to the 4000s, and these were priced at the $8 window as we went out at 4:15 on Friday. I don't like to be the first one to buy the new big level, the 4,000 level. I would rather see something where we come in, and maybe test and hold that 39.15 level on Monday, and then the strikes below 4,000 will decay, and you can probably get an $8 window down here at 39.80 or 39.90. That's where I would rather be in a call if I were looking at these calls coming into the day on Monday, these March contract ones. Okay, that's it. I hope this video helped you out and gave you a good idea of where we're at. Just keep in mind this 39.15 level, and that we still have an unresolved level to the upside with ES to take care of. Okay, have a great rest of your weekend. Good luck and good trading.